This is Alex Mahoney here with Coda Financial Coaching. And as many of you know, we have been in what people call a crypto winter since about October of 2025. It's now February 2026. So the value of Bitcoin in particular has dropped almost half in those intervening 4 months. And this is kind of an example of why I steer my clients away from crypto in general. This article does a pretty good job of outlining those reasons. I wanted to point out a couple of them. But at the same time, I recognize that some people do want to be in alternative assets. And I'm not necessarily going to discourage you from doing that if you want to take on some risk and hope to hit a good coin or a coin that goes up, especially if Bitcoin reemerges. I definitely don't want to discourage you from taking that opportunity, but there is a way to be conscientious about it if that's the route you decide to go, rather than investing in a more traditional S&P 500 fund or total stock market index fund, as I generally advise my clients to do. So first, we'll get into the reasons why I continue to think crypto is risky. And I think this article in the Wall Street Journal last week does a pretty good job outlining it. So really the first reason, if we scroll down here, this is a really good point, one that I hadn't even thought about, is that crypto is basically competing for dollars. Since it's not an asset that's regularly used, it's competing for investing dollars with other alternative investments too, such as gold, silver, and prediction markets. Those prediction markets, those can be sports, they can be politics, they can be any number of things. There are a million websites out there catering to people who want to bet a lot of money on very obscure topics. So when something becomes the next biggest trend in alternative investments, the dollars that were in crypto tend to herd towards those assets, and people will sell out of crypto into those assets. So because crypto doesn't have wide adoption, it doesn't have staying power when other big alternative investments or popular, sexy alternative investment alternatives emerge in the market. So that's really reason number one. As opposed to the bigger S&P 500 companies, people are always going to want to be invested in those because those are more established and they show consistent revenue and their products are widely used and adopted. So that's the first reason, this new shiny objects, that the fact that there's alternative investments out there. Another big reason that I saw that is a really good point is when there is a bull run in crypto, once again, because crypto doesn't have wide adoption, people see an opportunity to sell. And when certain people start to sell, or certain influencers in social media, or there's a big movement, once again, there tends to be kind of a herd mentality in alternative investments, especially when it comes to crypto, things like Bitcoin. So people will tend to take profits and will pull the rug out from underneath you if you have a more of a buy and hold strategy for crypto. So those are, two big reasons why I tend to advise clients to invest in something a little more traditional. Now, I recognize once again that people are going to want to get on the train and find the next biggest thing. And there is a conscientious way to invest like that. And it's called the barbell method of investing. Now, the idea is that you set aside a certain part of your portfolio, usually no more than 20%. That's actually on the high side, to invest in an alternative asset that you truly believe in, that you think has a good chance of making you very wealthy. And the idea is that this 10 to 20% that you have invested of your portfolio in this asset is going to bring the vast majority of returns to your portfolio. Now, the other 80%, You don't invest it in a more traditional long-term investment that I typically advise my clients to do, such as that S&P 500 or that total stock market index fund that we would see in Vanguard. You would instead invest it in a very safe asset. I would actually advise you to stick with more treasury bonds, long-term treasuries, super safe assets. And the reason being is that a lot of times crypto is actually going to move with the market, but even more drastically so. That is, if the stock market drops, crypto is going to drop even more. Bitcoin is going to drop even more, and it's really going to do damage to your portfolio. So the idea is that if you really believe in crypto, you'd be fine having 80% of your portfolio in super safe assets because most of the return on that portfolio is going to come from those very risky investments in crypto or whatever other coin you have. And if that investment that you have does go belly up, at least you have 80% of your portfolio highly protected and you don't really lose a ton. Yes, you may have lost that 10 to 20%, but it's not a ruining event to your long-term finances. And you really have that the vast majority of your portfolio protected. So the idea, it's called a barbell because you have two extremes. You have the very safe extreme and the very risky extreme that you expect to make you very rich, for lack of better words. So if you choose to invest in that very risky asset in 10 to 20% of your portfolio, a good option for that other end of that barbell that I would suggest you do is investing in this Vanguard short-term treasury index fund. So that is a very super safe investment. If you want to lean it, if you want to get a little more yield and you think the interest rate risk is not too much, you could go towards a more longer term treasury index fund as well. But basically, this is a super, super safe investment that is going to preserve the rest of your portfolio while you count on the 20% that's in that risky investment, whatever you choose it to be, working very hard to get you those excess returns that you're counting on. So anyways, if you have any questions on this barbell strategy, please drop it in the comments and let me know what you think. Thank you, everyone.